Administering Title IV Aid for Transfer Students, featuring Trevor Summers, Training Officer.
Hi, everyone. Welcome to Session 12, Administering Title IV Aid for Transfer Students. My name is Trevor Summers. I'm a Training Officer with the department, and I'm happy to be here with you today to discuss this important topic. Looking at the agenda, this outlines some of the things we're going to discuss. First, we're going to tackle what is a transfer student, then focus on the transfer student monitoring system. Then we'll tackle some student eligibility general provisions, and then discuss how you work with these transfer students as far as their Pell grants go. And then when it comes to their direct loan issues, we'll discuss that also. And then we'll also discuss some smaller issues that may come into play in case you have a student in this category withdraw and they may be in an overlapping loan period. So let's go to the first topic. What is a transfer student? Now, here's what we want to say here. There's a transfer student, and then there's a mid-year transfer student. I think those are two different students in this respect. A transfer student is someone who has earned credits for study at another school. We'll call that School A. And then they want to transfer to your school. We'll call that School B. And of course, they want to bring over any of those credits they earned from School A to your school, School B. Now, the student may have attended School A several years ago, 10 years ago, 20 years ago, or more, and now they're transferring to your school starting maybe this fall or next spring. Is that a transfer student? You bet that's a transfer student, but that's not a mid-year transfer student. A mid-year transfer student may have started attendance at School A during the same award year, and now they want to transfer to your school, School B, during the same award year. That is a mid-year transfer student, and that's the type of student we're going to discuss today. Again, there's a difference between the mid-year transfer student and a transfer student. Our discussion today, when we tackle these concepts of how to work with these students, is going to be limited to those students who transfer in the middle of the award year. So the first thing to tackle is this concept of transfer monitoring and some general provisions that determine what you do in these situations. Regarding transfer monitoring, I want you to see this screenshot of the National Student Loan Data System, or the NSLDS, and we're going to focus on the section for transfer monitoring. Remember, on the NSLDS website, you can log in and see different tabs or sections of this website. And you can see at the top of the screenshot, there's tabs for menu, aid, enroll, GE for gainful employment, etc. Look to the extreme right. The last tab on the right-hand side says TRAN. That's for transfer monitoring. That's where you click to get to the transfer monitoring process. And you can see in the right-hand side of the screenshot, there's a section emphasized with a red circle. That's where you would go to click on to work on things like your transfer monitoring list, to populate the monitoring alert review process, and to define your school transfer profile. So whenever we're discussing this transfer monitoring process, you should be aware where on the NSLDS you have to go to get into these areas. So here's what we mean by the transfer monitoring process. This should apply to any student who attended another school before they came to your school in the same award year. So here's what has to happen. Someone at your institution should look at these new students to see, are they a mid-year incoming transfer student? And if they are, they need to be added to this list. That's why the first bullet on this slide says you have to identify students transferring into your school during the award year. Then you have to provide their identifying information for all of those students in the NSLDS so we know who those students are. Once you do that, the NSLDS will alert you to any relevant changes in the student's financial aid history. So let's look at that a little deeper in the next few slides. This 3-step process, and this is required. This is not optional. It's required of all schools that participate in the federal student aid programs. The first step is to inform. This is where you create a list of these incoming transfer students that you want the NSLDS to monitor on your behalf. You can create this list on the NSLDS website directly by just data entering students one by one, which may be fine if you have a small enrollment and small numbers of incoming transfer students. Or you can create this list in your own software and submit this data in batches to the NSLDS via the Student Aid Internet Gateway, or SAIG. And if you create these batches in the proper file format, you can upload them to the SAIG, and it should be able to import them and populate this as needed. So the last bullet is important. You're encouraged to add students to the list who have received Title IV aid, but will not be receiving it at your school. They're not receiving financial aid at your school this year, so we should not run into any issues with annual loan limits or annual grant limits. Nevertheless, for those students that are not aid recipients, you're encouraged to add them. The next step is for the NSLDS to monitor this list of students. Once your list has been established, they're monitored for any changes in their financial aid history. The NSLDS is going to monitor those students from 30 to 120 days, depending on their enrollment begin date, and depending on the time frame you established when you set up the school's transfer profile. Now, why is that monitoring necessary? Here's why. The third step. That's the alert step. That's when the NSLDS will notify you in case another school originates a new loan or a new grant, or if they report a disbursement on a loan or a grant, or if there's some loan or grant disbursement revised or canceled. That's important because, after all, you're working with this new incoming transfer student that's transferring in the middle of the award year, and that student may have used 50% or maybe 40% or maybe 60% of their financial aid eligibility at school A. When they come to your school, you look at the NSLDS to make sure you build the student's financial aid package properly, so you don't inadvertently overaward or allow the student to receive too much financial aid. So if you look at the NSLDS at the time you're building the student's financial aid package, you should have accurate info to build the package properly. Then you move forward with notifying the student of their aid eligibility and, of course, dispersing aid once the student starts enrollment. The reason why you're notified for these students that have some change in their history, you could build the student's financial aid package properly, but after that point, let's say a week or two goes by at another school, school A does something different with their Pell or does something different with their direct loan, they disperse more money or they disperse less money, that could affect the financial aid package you built for that student. And you need to know about it to revisit the financial aid package you built, to compare the financial aid the student received at school A, to make sure no limits are exceeded. That's the whole purpose of the transfer monitoring alert system, and that's why it's needed for every incoming transfer student. Another issue that comes into play with these incoming transfer students comes in the topic of verification. You may have a student that was selected for verification and verification was completed at school A. Now the student comes to your school and you have to complete verification also. If the student was selected for verification and was properly verified by another school that's transferring, another school at school A, in some cases, you do not have to complete verification. If that verification was performed for the same award year, and if the student's data on their ICER or on their FAFSA has not changed, and if you obtain a letter from the previous school that confirms verification was completed and that lists the relevant or the pertinent ICER transaction number, you can accept that for verification purposes. Now, this is a may This is not a must. You don't have to do this. If you wish to go ahead and do verification again, you can. This is just something to keep in mind in case you know that it's done at another school and you want to accept it at your institution. This topic of satisfactory academic progress is important because you have to consider those grades from another school that's coming from school A to your school and school B whenever you calculate or assess the student's satisfactory academic progress. Here you have some options. You can see in the first bullet, it says that transfer credits that count toward the student's current program must be counted as both attempted and as completed hours. That's necessary for the quantitative measure at SAP. That means those transfer credits that count toward the student's new academic program at your school, those have to be counted as both attempted and completed. But the second bullet is important. It says the credits not counted toward the student's degree program may, and that word may is important, may also be counted at your school's discretion as described in your SAP policy. So you can write your SAP policy in such a way that it only considers the hours that apply to the student's new degree plan at your school, or it looks at all of the hours that the student transfers in and counts that in the quantitative measure. If you choose that latter approach, then the student may hit their limits before the other students. So it's something to keep in mind when you sit down and write your school's satisfactory academic progress policy, which way you want to write it or which way you want to craft it. So why all these steps? All these steps are just to ensure that the student maintains student eligibility as they transfer from school A to school B, and to make sure the annual federal student aid limits are not exceeded. The next thing I want to discuss is one of the most common. That's how to administer the federal Pell Grant programs for these incoming transfer students. Here's what you should do. When it comes to considering or approaching these Pell Grant calculations, remember, you have to always approach the federal Pell Grant awards from an award year perspective. And the award year has a specific definition. The award year is always July 1 to June 30. That's different than a fiscal year or maybe different than a budget year. The award year has a specific definition of July 1 to the following June 30. You have to see what the Pell Grant program, which award year that Pell Grant fell into, and that's how you're going to track these annual limits. Then you have to use the appropriate Pell Grant formula to determine the award amounts based on the student's payment periods. That's when they're going to enroll and when you're going to disperse the aid. And you disperse the aid up to their remaining amount for that award year. So for transfer students, you need to look at the student's loan record on the NSLDS or on the Common Origination and Disbursement System to see what percentage of Pell Grant that student has received, or you might say used, or utilized, or benefited from during this award year. That's why the first bullet on the slide shares that a transfer student's remaining Pell Grant eligibility is reduced if the student received Pell Grant funds for the same award year at a prior school, at school A. So this is how the Common Origination and Disbursement System calculates that. It looks at the amount dispersed at the prior school, school A, and it compares that to the scheduled award at the prior school, school A, to determine the percentage used. So in this case, we can say for this fictitious example, maybe the student had a scheduled award of $5,000 of Pell Grant funds, but the student received or used $5,500 at the previous school, school A. That student has used a percentage of their scheduled award. That percentage is 110%, and that is okay. That is okay because the student may have received Pell from school A and may have received the year-round Pell Grant, which, as you know, means the student can go above and beyond the 100% limit for a given award year. So this is an example of what you may see on the NSLDS when you're looking at these percentages. One more note on the year-round Pell Grant. Remember, the students can receive or may be able to receive up to 150%. If you have a student in this category, then you need to be clear that when that student receives Pell Grant money, the first 100% of the scheduled award is the initial component of their Pell Grant. Above that is this 50% maximum of the scheduled award. That's the additional component. Not every student will qualify for this, but many of your Pell Grant students will. You need to remember that for that additional component, that extra 50% maximum, the students must be enrolled at least half time in the payment period for which those funds are dispersed. So what we're going to tackle in the next few examples regarding the Pell Grant is just going to assume some basic numbers just for discussion's sake. And we're going to assume that the student is eligible for Pell Grant funds and that the scheduled award for both schools, School A and School B, is $5,000. May not be like that in the real world for all your students, but for these examples, we're going to tackle that. So on the next slide, here's what we want to do when we look at awarding the remaining Pell Grant eligibility. We're going to take 150% since that's the maximum, and we're going to subtract the percentage of the scheduled award already used at School A. That's going to leave us with the maximum percentage of the scheduled award the student may receive at our school, School B. We're going to have to always use percentages, not dollar amounts, to determine this remaining amount. Once we have that calculated, we're going to disperse up to the full amount for each payment period according to the appropriate Pell Grant formula, rather than apportioning these evenly across payment periods. That means this: if we see a student has $2,000 left based on their Pell Grant after the percentages are calculated, and if they're eligible for $2,000 for this new payment period, we're going to disperse that $2,000. We're not going to proportion it over the upcoming spring and the upcoming summer to give them $1,000 and $1,000. We're going to disperse the Pell just like the Pell Grant formula specifies in that amount. And then once the student hits the 150% limit, then that's it for that award year. Here's a real quick example of how to do that. This is similar to one we already tackled a few moments ago. If we have a student that qualifies for year-round Pell, we're going to take 150%. We may see that the student used 110% at School A. They're going to have 40% remaining. So we take the scheduled award at the transfer school, that's our school, multiply it by the remaining percentage of 0.40. And if that scheduled award was $5,000, we're going to multiply that by 0.40. That's going to leave us $2,000, and that's going to be dispersed in the next payment period up to that $2,000. Now, what if the student does not qualify for year-round Pell Grant? That's okay. We're going to use the same approach. We're just going to limit it to 100% scheduled in the award year, not the 150. So we'll do the same thing. We'll just do the math slightly different. Here's an example. We have a student who went to School A, which happens to be a quarter school, meaning their academic calendar is on the quarter system. The student attends the fall quarter there. Student probably receives a third of their Pell, or 33%. Then the student attends the winter quarter, and then the student withdraws from School A. No problem. This happens every day. The student withdraws. School A updates the NSLDS and updates the Common Origination and Disbursement System to show the student received or used 75% of their scheduled award. So what does this mean when we're tackling the annual Pell Grant limit for this student? If the student's transferring to our school, which I'll call School B, and if we use Pell Grant Formula 1, the normal disbursement for spring for a student with a scheduled award of $5,000 would be $2,500, or roughly 50% of this scheduled award. Would the student be eligible for this amount for this spring semester that this incoming transfer student is starting right here at School B? The answer to that is yes. This student could get the $2,500 if they're starting at our school and they're enrolling at least half time and they qualify for the year-round Pell. The student could get that amount. So again, why are we doing all of this work? Why are we taking all these steps? It's very simple. We have to ensure that the annual federal Pell Grant limits are not exceeded. As you know, you can look in the Federal Student Aid Handbook or in the regulations, and it outlines the amounts that students can receive based on the Pell Grant disbursement schedules, based on their enrollment status, their expected family contribution, etc. We're taking these steps to look at this mid-year transfer student to help them as much as we can with Pell Grant dollars, but still staying within the parameters of how the program works. We're taking these steps to ensure that their annual Pell Grant budget or their annual Pell Grant allowances are not exceeded. The next topic we should tackle is regarding the direct loan eligibility this incoming transfer student may have. Approaching this direct loan eligibility is different than we discussed under the Pell Grant program. When we look at the student's direct loan eligibility, we don't look at the award year, we look at the academic year. The academic year is a different measure. That's a measure that your school establishes to determine how long your academic year is for federal student aid purposes. You then use the appropriate annual loan limit for the grade level that the student has achieved or reached at your school, not at school A, but at your school, school B. And then we have to determine what the proper loan period is. The loan period is a period of time for which the direct loan funds are intended. That might be the academic year, or that might be some other period of time. Now, whenever you establish the loan period, you should be aware that there are rules regarding how short and how long the loan period can be. If you work at an institution that has credit hour programs that are offered in standard terms or non-standard terms with substantially equal length of at least 9 weeks, we call those SE9W, substantially equal at least 9 weeks, then the minimum loan period is the term. Is the single term. That might be a semester, trimester, quarter. But if you work at an institution that has the academic programs in clock hours, or maybe non-term credit hour programs, or non-standard term programs that have terms that are not substantially equal in at least 9 weeks in length, the minimum loan period is not the term. It's different. The minimum or the shortest loan period in that situation would either be the length of the academic program, if that program is shorter than an academic year, or the remaining portion of the program, if the student has a remaining portion shorter than your academic year, or the academic year established by the school. Now, this is important because we have measures to show what the academic year needs to be. The academic years have to be defined by the school, but they have to be at least the minimum length established by the statute, by the Higher Education Act. And here are the minimum lengths. If you work at a semester or trimester school, your academic year for federal student aid purposes should be defined as 30 weeks and 24 credit hours in length. That's the minimum. It can be more. If you work at a quarter school, your academic year has to be defined as at least 30 weeks and 36 credit hours. And if you work at a clock hour school, the academic year for federal student aid purposes has to be defined as 26 weeks and 900 hours. These are minimum measures. They can be defined higher than this. This is the amount of academic work a full-time student should be expected to complete and the time frame when that's done. Once you have this established, it acts as a benchmark measure or a template or a yardstick. Once this is established, we can compare it to the actual length of your program or to the portion remaining to determine how long your programs are and how much is remaining for these students. It's also important in the loan world because this borrower is restricted to receiving no more than their annual loan limit in any given academic year. Then when the borrower reaches the end of the academic year, the next academic year begins and the borrower can access a new annual loan limit. When we get into the academic years used to determine or track the student's annual loan borrowing, there's a few different approaches we can take here. One is called the scheduled academic year. That's proper for schools that have standard terms and substantially equal in length and at least 9-week terms. The scheduled academic year simply means that the school year typically starts and ends on roughly the same date every year. But if you work at a different type of school, you can use a borrower-based academic year. And there are 3 different variations of those: borrower-based academic year 1, 2, and 3. Those may be proper for clock hour schools or for non-term credit hour schools and schools that have non-equal, not substantially equal 9-week terms. To determine which of these approaches or which of these academic year measures you should use, look in the Federal Student Aid Handbook, Volume 3, Chapter 5. It gives a complete listing of these, and it explains which one is needed for each type of school. One of the main issues here for these transfer students with loans is this concept of overlapping academic years. And simply put, if a student transfers from one school to another school, or if they even change to a different program at the same school, there may be an overlap of these academic years. And this overlap is going to affect the amount of loan the student can borrow at the new school or for the new program. Here's an example. This is an example of a student that's in a school, and the school uses the scheduled academic year to track the annual loan limits and then transfers. Let's look at this. It says this student attended school A and received $1,750 in subsidized loans as a first-year student. The student was originally awarded fall spring loans for $3,500, but the student did not return for the spring at school A, and school A modified the existing loan. School A uses the scheduled academic year to track the annual loan limits, and school A defines its scheduled academic year as fall and spring. You can see in this graphic, the blue section shows the fall term of August 25 to December 17. It also shows the entire academic year of fall and spring that starts August 25 and goes to May 10 of the following year. This student leaves school A and transfers to school B, which uses BBAY1 to track the annual loan limits. So this student is a first-year student at school B. The student can only receive the remaining $1,750 until the scheduled academic year from the prior school, that school A, ends. You have to see, when will the academic year at school A end? It won't end until May 10. So that has to be looked at, but the academic year reported to COD, reported by school B, is actually the academic year reported for school B. So you have to look at it from both ways. How much loan money did the student borrow at school A? That's going to tell us how much loan money the student can borrow at our school. And we're going to have to determine when the academic year at school A ends. And that means that's going to tell us when the student can borrow another annual limit. Now, one more comment here on this concept of going back to modify the student's original loan period. Even though the subsidized usage limit applies provisions are no longer with us, you still have to go into a student's history or student's loan record, a student in this category. You still have to update the loan's previously reported loan period dates or academic year dates if the borrower's actual attendance is different than the anticipated dates that were the basis of you initially reporting that info to the Common Origination and Disbursement System. So you still have to go back and make sure you modify that so we know. You don't have to change the originally reported academic year dates, but you do need to modify that loan period so we can have the most accurate info possible. So on the next slide, let's look at this student who attended school A and received $1,750 in base subsidized loans. The student transfers to school B for the spring. School B uses the borrower-based academic year 1 to track these annual loan limits. Again, student can only receive the remaining $1,750 until the scheduled academic year from school A ends. But after that scheduled academic year ends, the student can get more money if they need it. They can borrow another $1,750 before the end of their borrower-based academic year. That means their borrower-based academic year at school B, at our school that we're discussing right now. Although that first $1,750 from school A no longer counts, the first $1,750 from school B, that does count toward the student's annual limit, the student's annual borrowing. Or more properly, I would say the first $1,750 from school B does count toward the student's borrower-based academic year. So let's look at the next slide, and this is a little different. This is a student who transfers, and this is not a first-year student, but a second-year student. And a second-year student has a little different annual loan maximum. So in this example, this student attended school A as a second-year student, and the student received $2,250 in subsidized loans. I would say that's $2,250 in base subsidized loans. We're talking about subsidized loans. We're talking about base loans to keep it simple here. The $2,250 is one half of the $4,500. So it's similar. You can see the student's revised loan period, August to December, and you can see the entire academic year, August to May. The student transfers to school B for the spring. That school uses BBAY1 to track annual loan limits. The catch is this student is a first-year student at school B, not a second-year student. The student's a first-year student at school B, so the student cannot receive another $2,250. They can only receive the remaining $1,250 until the scheduled award year from school A ends. Where did we get the $1,250 from? It's the difference between the $3,500, that's the annual base amount for a first-year student, and the $2,250 in the annual base amount that the student borrowed at school A. So is this student out of luck? Look at the bottom of this slide with me. After the scheduled academic year from the prior school ends, the student can receive another $2,250 before the end of the borrower-based academic year at school B. Although that original $2,250 from school A no longer counts, the first $1,250 from school B does count toward the student's borrower-based academic year. And since the student only received $1,250 in their first portion of their borrower-based academic year, and the student's still a first-year student, that means the student could borrow an additional $2,250 if they chose to. If you work at a clock hour or a non-term credit hour school, you need to be familiar with this borrower-based academic year 3 approach, because you may have this concept of an abbreviated loan period come into play, and you have to treat that a certain way. Here's what we're saying here. If you have a student that transfers into your school, and maybe if you work at a clock hour or a non-term credit hour school, and you have to use borrower-based academic year 3 to track this, if the academic years overlap, then your school, School B, again, has to formally complete School A's academic year before the student may access a new loan limit. So School B, that's where the student's going. They have to complete the academic year from School A. But here's the catch. The period that's needed to complete the academic year from School A may not meet that regular definition of a minimum loan period. So what happens here? This is called an abbreviated loan period, and you may use an abbreviated loan period to allow the student to borrow some money until that original academic year is completed. And you may, this is not a must, if you have a short abbreviated loan period or a short period of time that may be just a week or two, you don't have to use this. You can. Here's an example. Let's go to the next slide. Let's say the student attended School A for the fall term, received $1,750 in subsidized loans as a first-year student, then did not return. After School A discovered the student would not be attending the full year, They shortened the loan period to reflect the fall term, canceled the spring disbursement. The student transfers to School B to start a 2-year clock hour program on February 12th. The student can only receive the remaining $1,750 until the scheduled academic year from School A is over. What School B has to do here is they create an abbreviated loan period that starts when the student starts, in this case, February 12th, and it ends at the last day of School A's scheduled academic year. So there's a short abbreviated loan period here that has the starting dates of February 12th and the ending date of May 10. That is the abbreviated loan period, and it ends on the last day of the academic year of School A. So the student transfers to School B. School B creates this abbreviated loan period. The student can borrow whatever remaining funds are available from the annual limit at School A. The catch is you have to use the appropriate cost of attendance and the EFC for this abbreviated period, and you have to make 2 loan disbursements unless your institution is exempt due to the low cohort default rate relief provisions. On the cost of attendance and the EFC, you can look at this abbreviated loan period, and it's roughly 3 months in length. That means you would use a cost of attendance that's applicable to a 3-month period, not a 9-month period, not a 12-month period, but a 3-month period. And you use the 3-month EFC when calculating their eligibility. Not a 9-month EFC, not a 12-month EFC, the 3-month EFC. Here's an example. This first section shows the School A's scheduled academic year. It's August 25 to May 10. And then this School B establishes the abbreviated loan period. This short abbreviated loan period is not tied to successful completion of the program. So what we mean here is it's not subject to the proration limits that may apply in case the student was enrolling in a program shorter than 1 year, or they had a period remaining of less than a year. So there's no proration needed in this situation. So School B's abbreviated loan period is going to start February 12 and go to May 10. After that, guess what happens? School B's first full borrower-based academic year will start. That's going to start on May 11, and let's just say it goes to October 4 of the same year. Those are fictitious dates for the fictitious borrower-based academic year 3 program or a clock hour program. But the student starts their first full borrower-based academic year and has an entire new annual loan limit. So if this were a longer program, a 2-year or a 3-year program, you can see the first borrower-based academic year would go from May to October of 2022. And then after that portion, the borrower's second borrower-based academic year begins, and that would go from October 2022 to March 2023. Now watch this. Because of that initial abbreviated loan period, this student gets into their second borrower-based academic year, and they're approaching the end of their academic program. So if that initial abbreviated loan period meant that the remainder of the program that the student is shorter than an academic year, there's going to be a short period of time. School B's second loan period is going to go from October 2022 to, let's say, February 10, 2023. That's the second loan period, and it's going to end on February 10 because at that point, the student will be finished with the program. Now, in this situation, there will be a loan proration needed. That loan will need to be dispersed in 2 disbursements, and that loan will need to be prorated since the period of time remaining in the program is shorter than the definition of the academic year. This is why it's important to be clear on your school's definition of the academic year. Once we have that in writing, or once we have that established, we can compare it to this remaining portion. Once we see it's shorter, that tells us the proration requirements will apply. So here's an example of a student that, again, starts at School A, attends 1 term. The School B has this abbreviated loan period followed by a loan period that's shorter than an academic year, which must be prorated. On this slide, we look at a student that transfers from school A, that again uses the scheduled academic year, to a clock hour or non-term credit hour school that has a 1-year program. So this student started their enrollment at school A, transfers to school B. School B has an abbreviated loan period that finishes the amount of time that finishes school A's academic year. That's why it starts on February 12th and it goes to May 10. But since this is only a 1-year program, the student's first borrower-based academic year at school B, that's going to have to be short because at that point the student will have finished. The student will have finished on August 15. That's the first borrower-based academic year, but the student's loan period won't encompass the entire borrower-based academic year, only part of it. Once the student goes to August 15, that student will have graduated. That's another loan period that's shorter than an academic year, and that has to be prorated, just like we discussed in the previous example. The next slide shifts gears a little bit, and it shows a similar student that transfers to a clock hour or non-term credit hour program that is shorter than 1 year. So school B has an abbreviated loan period that's followed by a loan period that has to be prorated. So since the program is shorter than an academic year, the total amount of loan funds received between the abbreviated loan period and the regular loan period may not exceed what would normally be the total prorated amount for the program. So you may have to get your calculator out and determine what is the total prorated amount for any student enrolled in this program that is less than 1 academic year in length. That's going to establish the hard cap limit or the ceiling for any students borrowing in this program. And you're going to have to make sure that the amount of money the student borrows in the abbreviated loan period and the regular loan period does not exceed that amount. So here's one final slide on this particular section. This student starts at school A, they go to school B. At school B, which let's say may be a clock hour school, they've defined their academic year as 900 hours in length, and that's delivered over 30 weeks of time. But this actual program, the program they have is shorter than 1 year. Let's say the whole program is 600 hours in 20 weeks. The proration comes into play. That proration amount for any student in this program will be $2,333 of the base amount. We do the proration math and we compare to determine what the prorated amounts are. So if the student receives $1,750 in the abbreviated loan period, they can only borrow $583 in that following or that final period. And by sticking to that approach, then the student will not have exceeded their limits for this program that is shorter than 1 year in length. And the last topic we want to cover is this subject of students who may withdraw or cease attendance from your institution, and they may be in the middle of one of these overlapping payment periods. There's special treatment that's needed for the return calculation to do it correctly. So here's what we're saying. Because these payment periods for Pell Grants are defined within an award year, and the direct loan payments periods are defined within the academic year, this student who enters into a clock hour, borrower-based 3 academic year environment may appear to have 2 overlapping payment periods. And again, this is only going to apply to those students that transfer into a BBAY3 environment. Here's what happens. For return to Title IV funds calculation purposes, this school has to use a payment period that meets the requirements in this regulation, 668.4C, when you're doing the R2T4 calculation. So when you're performing the R2T4 calc, you have to make sure you're looking at that payment period that meets the requirements specified in that regulation. And that may be a little different than what you see on the surface. Here's why. That regulation, 34 CFR 668.4C, it defines a payment period as the time it takes a student to complete half the hours and half the weeks of the instructional time in that program or the defined academic year, whichever is shorter. Now, this applies specifically to clock hour or non-term credit hour programs. So we're only talking about that type of school in this situation. And this is another reason why you need to be familiar with what the definition of the academic year for federal student aid purposes is at your school. So what we're saying here is this abbreviated loan period that's designed to complete the academic year at school A, it may not meet the definition of a payment period as specified in this regulation, and that short abbreviated loan period should not be used for the return to Title IV funds calculation process. Here's what we mean. Here's a graphic of a student that transfers from school A to school B, and this student is enrolled at school B. School B has several things going on here. We have the payment period number 1 and payment period number 2. That's the original enrollment pattern that's desired for the student. But there was an abbreviated loan period used in the first portion of the payment period that was needed to finish out the academic year at school A. So let's say the student withdraws while they are in this abbreviated loan period. So if the student withdraws from school B during this abbreviated loan period, the school can't just use that little abbreviated loan period as basis for the R2T4 calculation. They need to use the R2T4 payment period number 1. That's what has to be used. The catch is this payment period number 1 is going to capture or pick up on financial aid that was disbursed during the abbreviated loan period and during this direct loan payment period number 2. So these things look out of sync, but because there was an abbreviated loan period, it's necessary to arrange them this way to make sure the student doesn't exceed their annual limit. So what we're saying here is in italics in the last portion of this slide. The end date of the payment period in this case can be the original scheduled date or a projected end date based on that student's individual progress, or you can use either one of these approaches. You just need to use one of these approaches consistently on what you use when you determine the end of the payment period. So on this slide, you can see there's a difference between the return to Title IV funds payment periods and the original abbreviated loan period. Once that original abbreviated loan period is finished, that starts the student's second loan period. And we could say that's represented by direct loan payment period 2 and direct loan payment period 3. This student ceased attending or withdrew during that abbreviated loan period. So the financial aid disbursed should include the Pell Grant and the direct loan disbursed during that abbreviated period. Now, if the school originated that second loan prior to the student's withdrawal, then you should count as aid that could have been disbursed the portion that's attributable to that 668.4 compliant payment period. That means that direct loan payment period number 2. That's the one that is compliant with that regulation because of its length. However, those funds cannot be disbursed to the student because the student never began attendance in that second loan period. So we have a portion of loans for that direct loan payment period number 2, and that portion is going to be just part of it, not all the loan funds, but part of it. And that's what we're trying to represent with the red brackets at the very top. The next slide will make it a little more clear. This example again shows that the student withdrew during that abbreviated loan period. So how do we tackle that little portion of the R2T4 payment period number 1? We take the days in the loan period that are attributable to that very first R2T4 payment period, and that may be a smaller number. Then we divide that by the days in the loan period. So in this example, we may say there were 50 days in that short period attributable toward the first R2T4 payment period. That would be the 50 days as represented in that red bracket. bracket divided by the days of the loan period, which may be 200. We do the math, 50 days over 200 days, that's 25%. So we would look at the $3,500 that was dispersed, and we would multiply that 25%, and that would mean $875 would be included as aid that could have been dispersed. We couldn't disperse it because the student withdrew before the beginning of the direct loan payment period number 2. This slide shifts gears a little bit. It says the same thing, but in this case, this student withdrew after that abbreviated loan period ended and the direct loan payment period 2 started. So in this case, the aid dispersed should include the Pell Grant and the direct loan dispersed during the abbreviated period. And if the school originated the second loan prior to the student's withdrawal, then the school should count that as aid that could have been dispersed. However, in this case, those funds can actually be dispersed because the student actually began attendance in the second loan period. So that's something to keep in mind for borrower-based academic year 3 students that may transfer in and then withdraw. So finally, to wrap up our discussion, we just want to point to some resources that you can go back and look at when you're back in the office and things are back to normal, sitting at your desk, and you're able to dig into these resources uninterrupted. Remember to look at these resources you see on this slide. Always stay tuned in to the National Student Loan Data System transfer monitoring and financial aid history batch file layouts. These are updated yearly, so you can get to those by going to my favorite website, the Knowledge Center, that replaces IFAP, by going to the library and then the NSLDS user resources. Check that periodically because that will be updated soon to give the new layouts in case you're using batch files to transmit large numbers of students to the NSLDS for the transfer monitoring system. Also, for transfer students, back in the Federal Student Aid Handbook, you can always go back and look in Volume 3, Chapter 1 to get general student eligibility requirements. The Pell Grant details are in Volume 3, Chapter 3. The direct loan details are in Volume 3, Chapter 5. And the return to Title IV funds details are in Volume 5, Chapter 1. And then certainly you can go to the Knowledge Center and actually drill down into the regulations that apply here. These regulatory sites like 34 CFR 668.22, these may not mean anything to you or anything to the new financial aid officer until you go to the Knowledge Center, click on the regulations, and browse to those sections to see what the regulations say in writing. And it helps to go to these regulations. These are the relevant ones for this discussion. So that's the end of this presentation. We're going to take questions here, and that's my email address you can use to communicate with me if you have any issues or any questions about this presentation. I thank you for joining me for these few minutes, and I hope you have a great rest of the conference. Thanks.